Hey there, everyone. Dave Keller here with Market Misbehavior. Today we're going to talk about some potential dividend plays that could help us to navigate through a period of market uncertainty. We're going to be looking at the Seeking Alpha platform to really set the table for the meal we're going to eat together. We're going to talk about market performance, some high-level market data, looking at equities, looking at sectors, looking at different styles, what we call factor ETFs, and then some of the different themes below there as well. We'll talk about a scam we can run on Seeking Alpha to find consistent dividend payers. And then I've highlighted 3 of those names individually that I'd like to walk through with you that, to be honest with you, stand out because of their decent and consistent dividend component, but also because the charts are actually pretty decent, which is certainly important to me. All along the way, we're going to be using the Seeking Alpha platform, which has become a core part of my toolkit to really understand market conditions. And we're going to start with the market data page. Here on the left side, we're going to select market data. Now, we're going to be jumping around this report just to sort of talk about the markets over different timeframes. But pro tip, I just want to remind you that you can left click on any of these column headings to sort that little section in ascending or descending order. And if you really want to understand the narrative of the market, what's been working and what's been not over different periods of time, I'm always going in here and going 5 days, 1 month, year to date at this point at the end of the first quarter to just really think about where the opportunities have been and where we would have underperformed had we owned different areas of the market, right? Because security selection certainly still matters here. Now, here as we get to the end of March, I'm going to be looking at the 1 month returns just because with the sell-off that we saw last week, I think that really tells the story of this market pretty well. But we will be jumping around a little bit as we go. Here over the last month, you can see the S&P is down about 7.6%, but note that small caps and micro caps have actually done better. The S&P 600 small cap ETF, ticker IJR, is actually down 6.1% versus the S&P down 7.6%. It's about 140 basis point performance gap there between small over large, or the small cap S&P 600 versus the large cap S&P 500. We can see, of course, over the last 5 days, we've seen a bit of a bounce in small caps. So while the S&P is down 2.2%, small caps are actually up. Mid caps are actually up. So could this be a period where small caps start to really outperform? Maybe too early to say that for sure, but it's good to see that there are areas of the market actually showing some strength there. So on the 1 month returns, obviously all the major benchmarks down about 6 to 8%, with the Dow lagging the most. When we look at the 1 month returns here on the equity sectors, we can see that only one of the S&P sectors, not surprisingly energy, is actually in the green, and it's in the green pretty big. While the S&P is down 6 to 7%, the energy sector is actually up almost 12%. This is obviously driven by the strength in crude oil attributed to the conflict in the Middle East and the uncertainty surrounding that. It's put a lot of upside pressure on crude oil prices, and that has empowered the energy sector to be a huge performance, a huge or strong performer on the right side of the list. And then a big gap down to utilities number 2, which is actually down 4.5% for the last month. Technology number 3, still down about 6.4%. On the downside, you can see 2 of the S&P sectors are actually down over 10% for the last month, industrials and healthcare in particular. So what you have to remember is that gap with the energy sector up about 12% and healthcare and industrials down about 10%. That's your opportunity set in terms of just sector rotation and trying to lean into what's working and leaning away from what's not working. Here's where it starts to get kind of interesting. We're sorting the equity factors table by 1 month returns. Now, this table here on Seeking Alpha is actually built from ETFs, what we call factor ETFs. Some of these are the Vanguard ETFs, like you see VYM as a Vanguard, a high dividend yield one. Things like USMV is an iShares ETF, MTUM, and others are iShares ETFs as well. But these basically are ways of thinking about different styles, right? Different types of stocks, different themes within the equity space. Now, you can see that most of these are down over the last month, similar to our major benchmarks. But I would note that the best performers out of this group are the highest dividend payers. Things like a high dividend yield, ticker VYM, things like dividend growth, DGRO, things like value IUSV, and value stocks tend to pay a higher dividend than growth stocks. So this is one of those times where it seems like the dividend component kind of matters. Over the last week, by the way, the areas of the market that are flat to slightly higher, looking at these factors, it's all the dividend ETFs, right? And the value ETFs. The growthy stuff has been struggling, while the S&P and certainly the AI theme has been struggling quite a bit. But if we look over the last week and if we look over the last month, the best performing factors have been those dividend factors. That's not surprising, because if you told me a month ago, look, the market's going to have a significant drawdown, we're going to blow through all of those levels of support we've been talking about, we're going to be down below 65.50 here toward the end of March, I'd be saying if you want to own equities, then I'd probably be leaning into dividend payers, because those are the ones that tend to have lower volatility, and that income component can just provide a better total return profile during a period of market instability. And sure enough, that general defensive approach has worked pretty well. Now elsewhere here, when we go to the market data column or page, we can get down to global equities, we can go to individual countries, we can also look at different areas of the market. So worth noting that while dividend pairs are doing well, bonds are actually not doing too bad. They're losing value on an absolute basis, but compared to the price deterioration that we're seeing on the equity side, the last month has been much more favorable to bonds over stocks. And indeed, that sort of stock to bond ratio has generally been tilting towards bonds here. Over the last month, of course, as I mentioned, crude oil prices, natural gas prices, anything related to energy has generally done better. Gold and silver and even platinum have been struggling quite a bit here, although from a technical perspective, there's some things holding up pretty well. Final point I would make would be some of the more impressive charts you're going to see are anything related to the US dollar. This is UUP, which is a bullish dollar ETF. It's actually up almost 3% over the last month compared to the S&P and the Nasdaq's returns, as we mentioned earlier. So as we validated here, right, as the market gets defensive, right, as the market starts to deteriorate, one area of the market that tends to be an interesting place to find a safe haven are in dividend pairs, because you have to remember, as an equity investor, you kind of have two general income streams or general potential sources of return. The one would be capital appreciation, which is the stock of the price going, or the price of the stock going higher than our entry point, right? So we buy at a certain point, we're able to sell it later, and that appreciation in the price of the stock we call capital appreciation, right? So growth in the price of the asset. We can sell it at a higher level ideally and pocket that difference. But we also have to remember there's a total return component. What that means is there's a dividend component. So as those prices are moving, a lot of companies, particularly in the value space, particularly these dividend growers we're going to talk about, pay a decent dividend. So your total return is the change in price, but also that quarterly payout or whatever it is, usually quarterly, in the form of a dividend. And what's interesting right now is because value or areas of the market are outperforming, you have stronger performance in terms of price, but you also have the income components. So on a total return basis, they tend to be good places to hide out in a period of market instability. So we're actually on that same market data page. I'm actually just jumping over one tab to what's called the Dividend Aristocrats. Now, if you look at this, what it says is that this is looking for S&P 500 members that have increased their dividends for at least 25 consecutive years. So we're immediately ignoring with this particular table anything that's born after 2000, right? So any sort of new emerging tech name or something isn't going to be included. Has to have a minimum market cap of about $3 billion, which means we're basically looking at the large and mega cap space. Has to have a minimum daily trading volume just to make sure that it's liquid enough, meaning we can find a buyer when we want to sell type of thing. But the most important part is that it's they've been increasing their dividends pretty consistently, right? Now, this page is going to default to descending order in dividend yields. This is basically looking at the forward yields. So based on their sort of trend in dividend payments, it's projecting out an estimated dividend yield over the next 12 months, which means if you buy a share of T Rowe, about 5.9% of your stock price that you pay today most likely is estimated to be paid back to you in the form of a dividend over the next 12 months. So it's a forward 12-month dividend yield is how to read that. Having said that, just because it has a high dividend yield isn't necessarily a good thing. And to be honest with you, what a dividend yield actually means is the dividend payout as a percentage of the stock price. So if the stock price has been going down, the dividend yield starts to look better and better. So a lot of times if you just scan for stocks showing a really high dividend yield, you're going to find names that are actually quite beaten down. And from a technical perspective, those are just not the names that I like to look at. So what I like to do is sort this table in descending order by quant rating. This takes advantage of Seeking Alpha's fantastic quant model and their quantitative research team, where they actually look at the characteristics of strong companies and indeed strong stocks over previous cycles. Now we're looking at what their quant model is actually rating pretty high compared to other names. And what's interesting is that quant rating doesn't just include things like something like dividend. It includes growth factors, earnings, price momentum, and other factors as part of their proprietary mix. We're going to focus on three particular names that are sort of in that top 10 when we sort the Dividend Aristocrats in descending order by quant rating. So consistent dividend payers, and they're rated pretty high based on the quant model. We're going to look in particular at Chevron, at ADM, which is Daniels Midland, that's in the consumer staples sector, that's a food products name, and then Nucor, which is a steel company. If you actually watch my video, I think it was last month, maybe a month before, we actually featured NUE. It's pulled back a bit. I think it could be a compelling setup here. Before we get to a little bit more about these three stocks and their technical setups, I do want to let you know, if you want more info on Seeking Alpha, it's a platform that I've really come to appreciate over time. If you go to marketmisbehavior.com/Seeking Alpha, you can take advantage as a new subscriber to a 7-day free trial and $30 off. That's 10% off your first year. This really cool features. We're just scratching the surface today, looking at their proprietary quant model, which has performed pretty well over the long term. And I would say after evaluating their model, reminds me a lot of institutional grade models I've used at larger investment firms. They have factor grades where they actually break down individual stocks and show you how they rate compared to those different factors. We can use the quant ratings along with other technical criteria for professional grade screening and filtering, and then you have access to all their members-only research and expert community. So again, go to marketmisbehavior.com/Seeking Alpha for more info on this powerful platform. Three stocks we're going to look at, starting with Chevron. Now, Chevron, to be honest with you, is basically an example of a bunch of energy stocks. If you look back at that list of Dividend Aristocrats, there's a number of energy stocks, particularly when we look at the stocks that are rated highest because of their proprietary quant rating. Chevron is one of those names that has just had a remarkably strong 2026. So the fact that it passes the screen, the fact that it's rated highly based on Seeking Alpha's quant model is pretty powerful. The fact that the chart is showing signs of accumulation, the fact that the price is making higher highs and higher lows, the fact that the price is above upward sloping moving averages, and there are not a lot of stocks featuring that particular pattern. Back in mid-2025, we saw a ton of these, and we kept highlighting them in our market recap show. These days, pretty rare, and a lot of them are in the energy space, so I think that's something to celebrate. The stock right now is overbought, which just means it's going up a lot, which is exactly right. At some point, you have pullbacks, and that's where we start to use some of these moving averages to find some short-term potential support levels. But for now, strong price, strong momentum, and most importantly, strong relative strength. And one of the consistent factors of all three of these stocks is that the relative strength line is going up. The relative performance is improving, and that means it's doing better than the benchmark. And that, I would argue, is vital, absolutely vital in a period of market uncertainty. Second chart is ADM, Daniels Midland. Now, a lot of food products names look really good earlier this year. A number of them have experienced some pullback. Cisco is one we were looking at, ticker SYY. That one actually gapped lower on an M&A announcement this week. But ADM is one that I would say from a technical perspective still holding up quite well. Similar to what we talked about with the chart of Chevron, this is a stock making higher highs and higher lows, and again, above upward sloping moving averages. Here I want to focus on the momentum, because if you look at the RSI, look how it's almost entirely in the year 2026 has an RSI above 50. That speaks to the fact that the up days are pretty strong relative to the down days. That speaks to the idea that there is plenty of accumulation happening, and particularly if you looked at that table, if you remember the table we looked at earlier with our benchmarks down 6 to 8% in the month of March, the fact that ADM is actually up in the month of March is pretty awesome and pretty impressive. Similar to what we saw with Chevron and with a lot of other energy stocks, the relative strength has been lights out positive. And so what that means is on a total return basis, you're outperforming the S&P by owning charts like this. So strong charts with strong trends, with strong momentum, usually result in strong relative performance. And that's exactly what we're seeing with this food products name, Archer Daniels Midland. And again, good dividend, consistent dividend, higher dividend yield than the S&P and the NASDAQ, but also rates pretty highly according to the Seeking Alpha's quant rating. Finally, we have Nucor, ticker NUE. Now, we talked about this chart on my show and some of my videos going into mid-March. This was a thing making just beautiful higher highs and higher lows. Looks a lot like the chart of Chevron right now, right? I mean, if you look at Nucor in sort of early mid-February, that's kind of what CVX is looking like. From there, the stock has pulled back. And to be clear, it's pulled back bouncing off the 50-day moving average, now trading between the 50 and 200-day moving averages. I'll tell you right off, if a stock like this breaks below the 200-day, for me, usually all bets are off. I was taught nothing good happens below the 200-day moving average, so holding that as a level of support usually ends up being pretty important. What's good, though, is the stock is just starting to bounce higher. The momentum may start to improve, but I'd like to see the RSI push further up above 50 and ideally above 60, representing new accumulation. I'm encouraged by the fact that the stock's bouncing higher a bit, which means it's outperforming here over the last couple weeks, which I think is pretty interesting. One sort of added note, and this is where I love using Seeking Alpha, even with other platforms, right? The benefits of Seeking Alpha is it's really good data. It gives you great quality data to start with, good scanning and screening tools, good models to help you just focus on things like dividend payers. But then I can apply all the rigorous technical tools and techniques that are important to me and use that as supplementary, right? As to add to that analysis that I've already done, just to validate whether I think it's an important time to maybe take a shot at a stock. With Nucor, the fact that it's pulled back, it's actually lining up with some really interesting Fibonacci levels. If we look at the April 2025 low on Nucor and we look at the February 2026 market peak, 38.2% of the way down is where we're highlighting here, right around 158. We can see that we traded for about a day or two just below that level before starting to bounce higher. If we do another Fibonacci retracement from the October low to that same peak, we can find 61.8% of the way is right here around 156. So from the April low to the February peak and from the October low to the February peak, we have what's called a confluence of support right around where the stock has bounced just a couple weeks ago. So for now, I like the risk reward, right? Limited downside. If you think about the Fibonacci levels and also the 200-day moving averages, potential stops, but we also think about the potential of the stock to start to improve. Breaking back above the 50-day, I think, would validate that bullish thesis and potentially unlock a return back to those February peaks. But that last example, NUE, Nucor, I think is a good example of where we can start to combine the power of the Seeking Alpha quant model and scanning tools, along with kind of traditional technical analysis tools that help us identify timing and identify when we may think about pulling the trigger. So there you go. That's a rundown of the current market conditions using Seeking Alpha's market data page, but also focusing on what they call Dividend Aristocrats. We also highlighted 3 stocks with some interesting technical setups, some strong performers in the energy sector. An example is CVX, some improvements in the defensive sector like ADM from the consumer staples sector, and then a strong performer that's pulled back potentially to an area of support like NUE. The consistent factor in all of those is that the quant model on Seeking Alpha rates it pretty high, and that tells me I might want to dig a little bit deeper. Hope you found this interesting. Again, go to marketmisbehavior.com/Seeking Alpha for more information on their platform. For now, I'll say have a wonderful week, and remember, it's always a good time to own good charts. Take care, folks.